Hello, I'm Anastasia Moroso, and this is Beyond 60/40. Today, we're joined by Mark Wade, partner at CAZ Investments. Mark joins us virtually in the studio in a conversation with my colleague here, Peter Repetto. They discuss the world of sports investing and the compelling opportunities in the market today. Then, in our Tech Spotlight series, I speak with Raul Perez, who is Executive Director of Structured Investments Group at Wells Fargo Securities, and we talk about the role technology is playing in the growth of this asset class. And finally, instead of our usual private market pulse snapshot, this week we wanted to draw your attention to the latest quarterly release of Alternatives Decoded, which of course is your comprehensive destination for the latest trends in private markets, hedge funds, and structured investments. Take a look. The second quarter release of iCapital's Alternatives Decoded is now available, and it provides the latest comprehensive market data across private markets. As a reminder, this chart-driven narrative delivers a dynamic analysis of the latest data on market performance, fund flows, deal activity valuations, and much more across the span of alternative investments, including private markets, hedge funds, and structured investment strategies. So here are some of the key highlights from our latest release. First of all, we've got an all-new in-depth overview section of the venture capital market. Second, the latest look at the deal activity, which is still expected to slow. Third, we're looking at the continued uptick in private credit flows on the iCapital platform. And fourth, we're seeing continued stability in real estate transaction volumes and prices. So together, Alternatives Decoded will help you quickly get up to speed on the outlook for alternative assets and help you stay ahead in a rapidly evolving alternative landscape. Check out the latest release at iCapital.com.
Hi, I'm Peter Repetto, Vice President Investment Strategist at iCapital, pinch hitting for Anastasia today. I'm excited to welcome our first guest, Mark Wade, partner at CAZ Investments. For more than 20 years, the firm has focused on alternative assets, but now manages over $9 billion in AUM. Mark is joining us virtually from Texas to discuss one of their key strategies, sports investing. Welcome, Mark, and thank you for joining me virtually in the studio.
It's great to be here, Peter. Thanks for having me.
So let's get started. Can you walk me through the origin of CAZ and how they pivoted into the world of sports investing?
Yeah, I'll make what's a very long story somewhat short here. The firm started about 25 years ago with the backing of several families, primarily here in the state of Texas, really as what we would call a multifamily office today. And as time went along, a greater focus grew on thematic private market investing. And eventually, the firm decided to go all in on alternative investments and build a private market thematic investment firm that now still focuses on investing the dollars of the shareholders, the team members, et cetera, and then inviting a very large network of investors to come alongside of us in whatever we're doing with our capital. So alignment of interest is very important to us. And so we've done a lot of different types of alternative investments over the years. We've been very active across a variety of different strategies, and we're excited to be focused on the world of professional sports today.
Sports investing has certainly taken off. Maybe let's take a step back and focus a little bit on your process. What are some of the key things that, goes into your investment process and when you're really thinking about the strategy of your firm?
We have a saying internally that goes something like this. If we can live with the downside, the upside takes care of itself. And what I'm referring to there is we are very focused, because we're investing our personal capital, on finding opportunities where we see a highly predictable outcome towards at least a return of our capital. And then from there, it's about identifying thematic tailwinds that are going to drive that investment forward in a very positive way. And professional sports is a great example of that. But sports have a very long track record of protecting capital in a variety of different economic environments. If you go back and statistically look at it, you'd be hard-pressed to find an owner of a sports team, certainly in the last 20 years or so, who's lost money on that investment. And so for us, it's a big focus on the downside. And then from there, it's looking at thematic tailwinds, which are going to drive the upside on the investment. And those things usually take care of themselves. And the theme with sports investing, actually, it's not about sports. It's about cord cutting. It's about this movement from traditional linear television to streaming television and YouTube TV and Amazon Prime and things of the like. And that shift in consumer behavior is really what's driving an interest in the rights of these companies and the media rights of these franchises, and then driving up the franchise values as a result.
Well, preserving capital has definitely been a prudent strategy this year, so I'm sure your investors have been welcoming that. But maybe let's focus a little bit on the environment today. How are you seeing the current, sports investment landscape, and what are some of the opportunities that you're really focused on as a firm?
Yeah, it's been an interesting development over the last 5 years or so. Forgive the pun here, but I still believe we're in the very early innings of the opportunity set for sports investing. One of the things that we like about this asset class is its stability. So through the course of 2025, we've seen a pretty tumultuous economic environment. There's been a lot of questions around interest rates. There's been a lot of questions around tariffs. There's been a lot of questions around a recession. And what's interesting to watch is sports continues to persist as an asset class. I mean, as investors, you can think about making a bet that's a cyclical bet, meaning we think the economic cycle is going to expand. You can make an anti-cyclical bet or counter-cyclical bet, thinking that you're going to see a contraction in the economic environment. What we like about sports is that it's acyclical, meaning it tends to operate outside of the economic cycle. It's as an asset class, if you go back and you look over the last 20, 30, 40, 50 years, we've had pretty much every type of environment you could think of. We've had recessions, we've had rapid economic growth, we've had rising interest rates, we've had declining interest rates. Through all of that, sports franchises have continued to grow in valuation. And I think it really comes back to what makes sports so unique is they occupy this very unique place in the social fabric, certainly of North America, but also globally around the world. And so we've been very focused on the big four North American sports leagues. We will invest, and we have invested in franchises and in assets outside of the big four, but that's our primary focus today. We're very excited in particular about the NFL. This is an entirely new opportunity set that hasn't existed to this point in time. And so that's where the partnership with iCapital comes into play. We're very pleased to announce this partnership and what we're rolling out to give investors access to the NFL for the first time ever. It's never been done before.
I'm sure your investors are very happy about that. But maybe now let's pivot a little bit and talk about the current landscape. Where are some of the areas that you're really interested in or focused on for today?
We like to describe ourselves as Switzerland, where we will invest in a lot of different areas of a given asset class. In the case of professional sports, we don't have a specific focus in any one league. We're not focused really exclusively in any one geography, although I will say that we like the dynamic in North America better than we like it internationally, and I can talk about that in a little bit as to why that's the case.
I kind of want to pivot off that a little bit. You did bring up, the focus in North America. I think one of the concerns for markets this year has been, do we sell U.S. assets? What are some of the markets or areas that you're focused on internationally, if at all?
Well, we can invest anywhere we want to, right? Because it's about identifying what we want to do with our personal capital. We're not restricted in any way, shape, or form, other than we want to go find the best investments that we can. And we still think that the best investments, generally speaking, are going to be here in North America. North America has a very different regulatory environment around it for professional sports ownership in the business. In North America, we have things like salary caps. We have things like limitations on debt. We have restrictions on the nature of ownership of who can actually own and control one of these franchises as opposed to just be a minority investor. We don't have things called relegation. Look, I grew up a New York Giants fan because my parents are New Yorkers, despite that I live in Texas now. So I'm a Giants fan. The Giants have been very bad for a very long period of time. They would have been what's called relegated if they would have been an English Premier League team, meaning they would have been bumped down to a second level tier organization and been paid less because of that. That doesn't happen in North American sports. They actually do the opposite. So those dynamics make it much more advantageous for ownership, generally speaking, across the board in North American sports than internationally. Internationally, you can borrow as much money as you want at the team level. You can pay your players as much as you want. If you don't perform well, you will be relegated. You can be owned by a sovereign wealth fund in control or a private equity firm. And so it creates some conflict of interest around, well, are you pursuing financial incentives, or are you pursuing social incentives, or are you pursuing winning incentives? It's hard to determine what masters you're going to serve there. So those dynamics make it harder to get comfortable with investing as much outside of the U.S. as it is primarily here in the U.S. And I don't just mean the U.S. Obviously, Canada has a large NBA and hockey contingent as well. We will invest internationally. We just have to be very selective where we don't have as much concern around those exogenous factors I mentioned.
Now, I know a lot of our questions have been focused on today, and our job as investors is to really look out over the future And maybe thinking about that, where are some of the areas that you see the long-term growth potential for sports investing?
I think there's a number of things that are going to happen. Number one is the way that we consume this content is going to continue to change. When you think about what cord cutting does to the technology stack of viewing, it changes it in a pretty big way. We've already started to see an element of like micro segmentation in terms of broadcasting, right? If you watch Monday Night Football, you can watch the traditional broadcast and you can watch the Manning cast. And watching the Manning cast, you're watching the football game, but it's also entertainment. It's Eli and Peyton and their guests talking about whatever they want to talk about. And that's going to continue to happen where, because we now have these various technology mechanisms we didn't have before, particularly around augmented reality and virtual reality, I think there's going to be a day where you put these goggles on and you can sit in your living room, but you're looking at what the players are seeing. You can follow one player and watch a play from their perspective. You can take and impose yourself into the game and your own sort of likeness if you want to pay extra to do that. So I think there's no better live content than sports. Nothing else will reorient someone's day or a community's day. It has a very unique place, and the demand for it is going to continue to be strong because of that, the way it brings social, communities together in just such a unique way.
All right, well, I have to ask, Mark, as a former college athlete, what are your thoughts on the investment potential in college sports?
The first thing I'll say is I wish that they would have come up with all the NIL stuff while I was still playing, although I'm not sure how much demand there would have been for a backup goalie in college lacrosse. But I think it's interesting. When you compare them side by side, a college sports athletic department versus a professional sports franchise, they make money largely the same ways. It's not identical, but it's largely the same, right? You get some type of a rights fee from a media rights deal that comes from the conference in the case of a college sports team, or from a league in the sense of a professional sports team. So you get media rights, you have ticketing, you have premium ticketing, and you have sponsorship, right? These are the areas that all these assets make money. And so they're very similar in that regard. Now, the difference is one of them is a for-profit enterprise. The other one is a not-for-profit. There's going to be good investments that get made in college sports and around college sports. I'm personally a little hesitant about how they're going to be structured and what that's going to do to the college game. I'm probably a little bit more of a purist than a lot of other folks. I'd love to just see a delineation between college sports and professional sports in terms of what's expected of the players and the student athletes, and what's not expected of them. I think the more you pay them and the more you push them towards being a professional athlete, the more they're going to act that way. And I think that college sports is it's such a unique cultural phenomenon in this country that doesn't really exist anywhere else in the world. I'd hate for us to lose that.
Yeah, that's a great point, Mark. But really wanted to say thank you for taking your time today and sharing your insights with us, and look forward to speaking with you soon.
Peter, it's a pleasure to be here. Thank you, my friend.
Today, in our Tech Spotlight segment, I've invited Raul Perez, Executive Director of the Structured Investment Group at Wells Fargo Securities, to speak about the impact technology is having on the structured investments market. Raul, thanks so much for joining today.
Thank you for having us, Deja.
It's great to see you. And look, you spent the majority of your career in the space of structured investments. I imagine you've seen quite a few things along the way, the key milestones. So talk about those and where are we today relative to the past?
So in structured, I've been in the business for 20+ years. Yes, you could imagine in anything in this world, 20 years is a long time, right? Things have massively changed in our industry, right? From something that's extremely manual process, person-to-person type of sales process, to something that has evolved dramatically. I would say that probably the biggest thing, like we've seen in all things in the last probably 10 years, is that there's some entrants into the market that come in and they disrupt, which is a good thing.
Yeah.
And fintech is that, right? So we've seen this massive growth in our business. Our business was about $100 billion business and stayed stagnant for many years. And it's bolstered up to $190 billion, I think, last year. So we almost doubled our business. And that's probably because of technology and how we married that with the human element. I think that's still very important. We can't just rely just on the technology. We need the human element to kind of drive that.
So obviously we've seen huge growth in the market. And at the same time, I imagine there's still some hurdles that are remaining to further scaling SI with advisors and perhaps end clients. What do you see in terms of what are some of those hurdles today?
So the interesting part is I think that in 2022, when we saw the 60/40 break apart, I think that was an eye-opening experience for many advisors and for clients, right? They started realizing that they didn't have this bulletproof portfolio like they thought they did. And they're starting to realize I need alternatives, not just alternatives as in the private markets, but also in market-linked investments or structured products. And I think that's really where we've taken a lot of advisors that were more hesitant to be in this business and drove them forward. We need to continue that. And what we've been using a lot is the technology side to help bridge that gap of the knowledge for those advisors to learn about the product, manage the product, and really utilize it properly. And the technology piece is super important because they become extremely scalable. They can manage a huge book of business with a little amount of time because you just click a couple of buttons and it does all the work for you.
Right. And by the way, you spoke about the 60/40 breaking down in 2022. Well, actually, we also had a mini episode of 60/40 breaking down earlier this year.
That's true.
Around Liberation Day. So, once again, advisors can certainly think about how to allocate to structured investments to really help that overall portfolio construct. But to get more specific around the technologies, can you share with us some examples of, what kind of processes or, tech tools advisors are using today most often to help with the distribution side or just manage the ongoing SI business?
Yeah, so there's three major components, I think. There's always the educational aspect, which is super important, not just for the end client, but for the advisor themselves. So that's really been bolstered up significantly, especially on the iCapital platform. The second piece is your marketplace, which is where you could find all of the deals and be able to back test them and visually see how the product's going to work, which I think is super important. And then the final piece, which I think is probably the most important, is the lifecycle management.
Right.
Our business was always really good at the primary side, so selling the product, but then we always fell on our face on the banking side because we couldn't manage all of those past offerings that we did because we're always focused on the forward. Right. And I think that's really the big driver of where tech saved all the banks' lives, right? Because we just don't have the budgeting that some fintechs do to be able to build all these technology pieces for the problems we had. And then iCapital fixed that for us, right? So for us at Wells. So I think that's the real driver, is that when you have that lifecycle portal, that advisor now could plan out his book of business over the next 60, 90 days to know what's coming due, what coupons are going to be paid, so they could proactively go into their book of business and actually make it better.
And that's a really big deal, especially as the overall structured investment business grows and rapidly as it has. But speaking of that, what is the plan going forward? What do you think happens with SI growth again? And, what are the tech tools that you think will play center stage?
Well, look, at Wells Fargo, we're doing the best we can to really drive this technology piece to our advisors, right? So we've made it super easy for them. As they log into their systems every morning, they immediately have access to that system. And why we did that was because we want our advisors to live a very happy life, and technology is going to do that for them. What we've noticed is that we've doubled our business in the last couple of years, which is significant, but we want to do that again. And just like we want to do that, I think the overall industry wants to do that. And I think the next step, right, is to make the advisor's life even easier. And I think that's how we move forward in the industry, but we're going to need to do that with tech. So we're going to need to find maybe AI to help bridge that gap, right? Maybe have AI work on something so that when the client feels that there's a hole in their portfolio, AI will help them guide them into the right product.
Certainly, technology has the potential to make the advisor's lives easier, which at the end of the day, it's about really solving the problem for the end client. And certainly tech seems like it could play a really key role in doing that with structured investments. So Raul, thank you so much for your time today. Thanks for joining us to talk about this important topic.
Thank you for having me.
Thank you. And we'd like to hear from you. Send us an email at yourquestion@icapital.com and let us know what questions are the top of mind for you and your clients. I'm Anastasia Moroso, and thank you for joining us today on Beyond 60/40. We'll see you next time.